So what I'm going to be taking you through today is going through some financial management for small business. So it's just to show you a little bit of insight, what you could know as a small business or what you should be focusing on. And as you can see there, I've called it what you ought to know. I'm known for my bad dad jokes, especially by my kids. So that's another dad joke. And it's about taking some money and growing it. And those are the little sprouts that are coming up. And hopefully we can do the same in your business and in all our businesses. Some people are actually saying, but who is David Zidel? So who am I? I've been facilitating and been a keynote speaker both in South Africa and internationally for the last 25 years. My focus has been always on education. I at some stage, I try to get away from it and try to do other things, but any business I get into, somehow I land up in the education part of it. So if you know kind of where your love and your joy is, that's where you should be staying. And I think I've now found the lane that I'm in. I'm the author of 2 books. I wrote a book called Basic Business Calculation. It surprises me that that book was written over 20 years ago. It's still selling. It sold about 25,000 copies over the time. So it's quite good. It was kind of like each year. It was originally through Penguin Books. It sold about 1,000 copies every single year. It's what they call an evergreen. The other book I wrote is I ran a couple of comrades marathons, and I found that there are lessons that you can learn through running that apply to life and business in general. So I put that together. My key focus at the moment, though, is on business simulation. So together with a colleague, Brian Similani, we created 2 business simulation games that we run in businesses. We got a couple others that we run as well, but these are the ones that we created ourselves. The one's called Gadol, which I suppose you know, if you understand Hebrew, means great. And it was just because there is a board game out there called Katan, and we thought we want to be Gadol. And it's a strategy and finance game. And the other one's Evaluate. It's electric vehicle. It's based on electric vehicles. So that's where the EV8 comes from. And it teaches you how to run. You CEO of a business, it teaches you how to run the business, and you simulate the business. And you can compete on either on price, compete on your technology, or compete in different regions around the world. And you play the game over 5 rounds, and it teaches you to think strategically. I won a couple of awards over the years. The one was Lecturer of the Year Award, and the one over there is the ORT Jet Mentor of the Year. I'm very proud of that one. In fact, in that year, I won 2 awards in the same year. The one was the ORT Jet Mentor of the Year award, and then my wife gave me an award, the Tormentor of the Year award. And then I'm also involved into online kind of things, and the online things are I host a business show for ORT Jet. It's called the ORT Jet Business Show. It's on High FM it's on every Thursday between 6 and 7. And I saw Vincent was online now, and he was actually one of the guests on the show. You can go back, and if you go into the High FM website, you can go and see some of the podcasts. You can listen to it. If you want to see it, you can actually go to my channel, which is the Random Thoughts of a Business School Lecturer, and then you can actually watch the interview if you want to. But let's get into what we're looking at. And it's about understanding business. And understanding business is about understanding the scoreboard of business. And it's about you understand the numbers so that you can use that as a tool to make the right decisions. It's like any sport. When you have a look at a sport, there's a scoreboard, so you can see what the score is and what you're doing. Here's a scoreboard for you. So this is actually a basketball scoreboard from a basketball game. But if you don't know who the home team is or the guest team is, or if you don't understand the whole thing about fouls and the players and the numbers, even if you've got a scoreboard, it still doesn't make sense to you. Now, some of you in business get an income statement, a balance sheet, and some ratios maybe, but you don't understand what it's telling you. So you've got to be able to simplify it. And it doesn't matter if you can't see everything, as long as you're understanding what the key points are. So here would be a scoreboard for some soccer matches, and you can see exactly what the score was, who won, and that's what we want to get to in business. We want to get to a point where we can see what the score is, and then we can make decisions on whether we need to improve or not improve. Warren Buffett said, accounting is the language of business. You have to understand the language to be able to understand what is happening. Now, you can go and do a 3 or 4 year degree and you can become an accountant, and you still might not understand business itself because you'll know how to tinker with it, but it's about using it in your business. What I tell people when I do my lectures on finance is I don't want to turn you into the mechanic. I want to turn you into a person who can drive the car. So the mechanic will create and tinker with all the things inside, but you've got to understand how it works. And one of the key things that you need to look at is you've got to understand that when you make a profit, that doesn't mean cash flow. And there's a big difference. And if you grow a business, it doesn't mean that you're successful. There's a saying that a lot of companies don't go broke, they grow broke. In other words, you can sometimes grow too fast for your cash flow. So it sounds like it's a bit too complicated, but you have to make a profit to be in business. You need to make sure that that profit translates into cash flow as quick as possible. Otherwise, you've got to limit how quickly you grow so that your cash flow can catch up with you. And I make the analogy and I say that your cash flow in your business is the same as the air that you breathe. So no matter how strong or how good you look, if you don't have air, you're not going to survive. In business, that air is your cash flow, and you need to be able to get cash flow. And we'll unpack this in a little bit more detail just now. One of the important things that you need to look at is your income statement. And that all that really is saying is, are we making a profit? Now, I said just now, profit is not cash flow. So you need to, first of all, make a profit and then make sure that it translates into the cash when you need it. But in order to make a profit, you need to have the sales at the top. You need to make sure that all those sales, the amount that you make, is not being absorbed through all your expenses, and then you make a profit. You also need to have and understand your balance sheet. And what the balance sheet is, it's just telling you what do you own and what do you owe. In the most simplest terms, that's what it means. And then you also have the cash flow statement just to unpack why sometimes you don't have the cash that you need in the business. So having said all that, let's unpack the income statement a little bit. Your income statement is telling you got your sales or your revenue. Okay, that is, and then you take off your cost of sales. The cost of sales is the cost that is directly related to your sales. Once you do that, you get something called your gross profit. Now, that's not your profit. That's just your profit, which is directly related to the product you're selling. Let's say this pen over here. Let's say it costs me 2 Rand and I sell it for 5 Rand. My gross profit is going to be the 5 Rand minus the 2 Rand gives me 3 Rand. But that's not my profit yet. I've still got to pay for all sorts of other things. I've got to pay for the rent. I've got to pay maybe salaries. I've got to pay for delivery of things in and delivery of things out. I've got to pay for all sorts of utilities. So I've got a whole lot of costs that are not directly linked to that product. And what that means is I have to be able to cover all of those costs. And the way I can cover those costs is by making more and more sales. And once you get all of that, you have your profit. And as I said before, that profit is not your cash flow yet. Okay. I can sell on 2 bases, really, if I simplify it. I can sell that as I buy something, you give me cash. That's one way of doing it. Another way is I can sell you something and you can tell me, okay, I'll pay you in 30 days or 60 days or 90 days. It's okay to do that. If I sell and you pay me 90 days, if that increases the chances that you're going to buy from me. If I didn't give you those terms, you might not buy from me. So that's why I might do it. Why I might not give you those terms is if I don't have the cash flow to be able to give you that. Okay. Just another illustration of this, how the income statement breaks down. Maybe this one's a little bit better. So you got sales, that yellow bit. You take off the blue bit, which is the costs that are directly related to the sales. That gives you your gross profit. You take off all sorts of expenses. You're left with operating profit. Then we take off interest. Then you take off tax. Then you take off, if you happen to pay dividend or any other expenses, and you get what we call the retained earnings, what you're left with. The reason why we have different summaries like that, that we slice the income statement up, because we could just say, well, just tell me quickly, what's my sales and what am I left with? But the reason that we have these different subtotals, those little yellow blocks, is for analysis purposes. It's so that we can understand what's happening with the numbers so that we can make better business decisions. So there's the term accounting, and that means to account for. That means to take what's happening and record it. But the question is, why do you want to record it? And you want to record it so that you can understand what's happening in the business. Okay. There's a concept of just three things, and maybe think of it like this whenever you're looking at it. It's the what, the so what, and the now what. The what is, what are we showing? Understand what you're showing. The what, the so what means, so what does this mean? So that's why we analyze it. What does it mean? And the crucial bit at the end is the now what. Now, what are we going to do about it? So you will run your business, you will look at what's happening, but then you will make decisions on, is that working or is that not working, or what can we do better? In a business that you're running, it's always important to keep looking back and saying, could I have done it slightly different that would improve it in some way? When you look, even this, I can simplify this income statement in a way that might make a little bit more sense, is if I get a bottle of wine and it's got I've got a lot of wine in it and I want to drink it. If I said to you, in a business, before I can drink that wine, I have to pour it through a funnel. And as I pour it through, there's holes and it leaks out. And what is that? Some of those sales is cost of sales. Okay. That's the cost of the product that I'm actually selling. Then I've got other expenses. And then when I've done all of that, I still have to pay taxes. And then I'm left with profit. And the profit is that little bit at the bottom, that little drop at the bottom. In whatever business you're in, and I'm sure we've got lots of different businesses, I want you to understand in your business, what is that little drop? What is that profit as a percentage of your sales? What you can do is you say, your profit, so you take that amount and you divide it by your sales and you get a percentage. In a lot of businesses, you're left with something between 8 and maybe 12% of that. What that actually says is that when I make a sale of 100, it sounds like, wow, I got $100. You don't. That 100 is actually only $12 to you. And it's important to understand that distinction. Every time you make a sale of 100, you're actually only getting 12. And if you look at it like that, I know this is an example with wine, but that's quite a sobering thought, is that you're not getting the 100, you're getting less than that. Okay. So have a look at that and then try, and you can even use ChatGPT or AI and go in and say, in my type of business, what should that, and it's called your net profit be? So we've got two things, and I'll go into a little more detail just now. You've got your gross profit percentage and your net profit percentage. Sales less cost of sales equals gross profit. If I do that same calculation, gross profit as a percentage of sales, there's a number. Generally, in different types of businesses, you're aiming at different GP percentages. Okay. As I told you, I host the ORT Jet Business Show. And by the way, if any of you have suggestions of anyone you think should be on the show, you can let Tracy know or even put it on the chat. Yeah, it'd be great. But this Thursday, we've got Yakov, who owns Moshi's, the butchery. And he's going to talk specifically around that gross profit. He's going to talk about in his business what that gross profit percentage should be and why. In different industries, that GP percentage is different. So depending on the type of business, you can only succeed in that. So for instance, a petrol station has a very low GP because they have lots of volumes. A restaurant has a higher GP. So your gross profit percentage in a restaurant type business needs to be 65%. And we'll see what it is with the butchery when we speak to Moshi's, but you need to understand what the norm is and then look at your business and say, am I there? Am I doing slightly better, slightly worse? What can I do about it? Okay. So that's around the income statement. So your income statement, if I show you in another way, you've got your sales, you take off your cost of sales, then you're left with your gross profit. Once you take that gross profit is in which industry you're in, or even with your products within the industry would have different GPs. Once we've got there, remember your GP, gross profit as a percentage of sales. Then you take off your expenses, you're left with profit before interest and tax, you take off your interest, you take off your tax, you're left with a profit after tax. And if you pay dividends, you're left with the retained earnings. And what happens, your balance sheet, which I'll unpack a little bit just now, but your balance sheet is telling you where did the money come from, where does it go to? Generally, the money you can get in the business is either debt or equity. Debt is money that is lent to the business. Equity is money that's invested in the business. Part of that's when you start. The funding of the business happens from inside the business as well. So that retained earning gets put back into the business, and that's what helps the business grow over time. There are some roads to profitability, and I wasn't sure where to put this next slide, but I'm going to put it here just to give you some idea of when you're in a business and you need to improve that top line. So here's the concept. Our aim is to get the bottom line to be better. Okay, we want that bottom line to be as much as possible. Okay, but the way you do that is to cut out as much as possible without hurting the business, those costs. But the way to get there is to get more sales. So in a business, you always need to look at saying, am I spending too much? Can I cut costs? But you can't save yourself rich. Okay, you can save some costs, but you can't become really wealthy through that. Where you become wealthy is the top line by making more and more sales. So that top line is very important, but you want the top line so that it affects the bottom line. There was a saying, and in fact, I was going through some old papers the other day, and I actually took this out of a newspaper once. There was an obituary to somebody who had passed away. And in the, like that you used to have in the classifieds, and I cut it out of the newspaper. Even in there, the guy was talking about somebody who passed away, and he said, what was the comment he said? He said, oh, you taught me that turnover is vanity, profit is sanity, but cash is reality. Now, imagine how important that was to this person, whoever it was. If when somebody passes away, that's the thing he tells him that was the most meaningful in his life, that he added to him. What that really means is when they say turnover is vanity, it's if you talk about how much your sales are, you're showing off, whether to others or to yourself. It's like, hey, I got 100 Rand in sales. That's showing off. That's vanity. Your profit is sanity. Your profit, it means that at the bottom, that profit is what you need to look at. But over and above all of that, cash is reality. You still need the cash flow. If I've got profit and the cash comes in too late, I might not be around to enjoy it. So how do I grow that top line? And there's a company called Growth Wheel that teaches how to grow these different things. And I took this from them. The best way to increase revenue and reduce your costs. If you're looking purely at profitability, here are 4 ways of doing both of those things. The first thing is to make more sales. Okay. And how do you make more sales? It's get more money from your existing customers. Is there a way that you can get more money from your existing customers? The other way is to increase your revenue from new clients, is go and find new clients. I've got sales, I'm selling to my current sales. How can I do that? The upsell is increased revenue from more product sale. Can I sell you another product? Are you buying a pot? And can I sell you the sand that goes in the pot? And can I sell you the flowers that goes in that? And then can I sell you the fertilizer? And then can I sell you a service where we will come and do all that for you? That's kind of what we call the upselling. Okay. Or you can increase your total revenue by increasing your prices. People are scared to increase prices because they think it's going to reduce the amount sold. And you have to look and see, is a product that you're selling, can people substitute it for something else very easily? If they can substitute it for something else very easily, and yours looks the same as someone else's, then it's difficult to increase prices because people will just substitute. But if you create something unique within your business, whether it's your service that you're giving, whether it's just you, whether people like dealing with you, whether you got something unique about your business, then when you can increase prices slightly and people won't go somewhere else because they can't substitute you. So that's your top line. The bit that is from the cost point of view, if you're looking to cut costs, you can reduce, you can do what we call cost reduction. You can reduce the prices from existing or new suppliers. Try and negotiate better prices from people who you're bringing things in. Your cost saving, you can reduce your expenses, somehow consume less or do less or use your assets more. You can get cost elimination. Like sometimes you're doing something and you just don't need it. One of the airlines once gave an example of this. One of the airlines, there's a story that their cost was too much on all the food, and so they cut out just 2 olives out of every single salad. And what happened there is that were doing millions of different flights. So it's 2 million, or they're doing millions of different lunches, and cutting 2 million olives out cost them, and they had an amount to it. The thing with cost elimination is you can do it as a once-off, but you can't continually doing it. Because if the next time they cut out the tomatoes and the next time cut out the lettuce, eventually they're not serving anything. So yes, you can look at cost elimination, but be aware that you could kill the product as you're doing it. Just an interesting story with that. My dad used to give a story of a guy who owned a horse. And he met with a friend and he said, "Hey, how's it going with the horse?" And he said, it's hard to own something that eats while you sleep. So the guy said, "Well, why don't you try cut the costs?" And he said, "How?" He said, "Well, you know what you're feeding it? Feed it 10% less." And that's what he did. He fed it 10% less, but still expensive. So the guy decided, well, maybe he'll do it again. Anyway, a couple of years went by and these guys met again. He said, "Hey, how's it going with the horse?" He said, "It's a funny story. Remember you told me to cut the food by 10%? I did that. Worked beautifully, but it was still expensive. So I did it again, and then I did it again." And he said, "Just when I taught this horse not to eat, it died." And it's a crazy story, but it kind of illustrates the point that you can cut costs, but at some stage you can cut too much and then you kill what you're trying to save. Okay. And that's your cost elimination. The other one, maybe a little bit better, is your cost efficiency. Reduce, buy in bulk maybe, or increase your productivity. Get some way that you can reduce that. Okay. So this is maybe, if you look at your business, if you can see, does this apply to your business, and can you use any one of these? A point behind this, and something that I want to tell you, is that often it's the little things that make the big things happen. Often we have a big problem, but sometimes if you tweak something a little bit, it can have a huge impact. And hopefully one of these things that we get from today's talk is around that. So that's a little bit more around the income statement. Just quickly, before I move on, I'm going to talk a little bit about the balance sheet, but any questions at the moment? Anyone got a question around this specifically? And if you've got a question, you can either put your hand up or put your camera and unmute. Okay, so I'll get to the questions a little bit later on then. So if we look at the balance sheet, all the balance sheet is showing you is two sides. It's saying, what do we own and what do we owe in the business? It's called a balance sheet because it's in balance. It has to equal. Okay. And really it works the opposite to what people think. It's first, where did we get our money? And then what have we done with that money? That's all it is. Okay. The key thing behind that is if two people make a profit of the same amount, it doesn't mean that they're performing the same, because what you own in the business is like your investment in the business. What you are making is your return on that investment. And it's very important to understand that that ratio is crucial. If I put 10,000 Rand in a bank and I earn interest of 1,000, or if I put 100,000 Rand in the bank and I earn interest of 1,000, you can't say, oh, they're performing the same because they're both earning 1,000. It's always, what are you earning as a percentage of what you've invested? And the key, that's what we call, and you must probably heard this term, return on investment. You have to look at what is the return on the amount that you put in. What's your ROI, return on investment, or the return on me, ROI. And so it's very important always to look at the numbers, but then do some type of ratio with those numbers. Okay. So some important concepts related to that is, do you in your business understand how much you need to sell to cover your costs? That's what we call the break even. At what point do you make no profit? And it's not that you want to make no profit, but you do want to know, how much do I need to sell to make that profit? So if I'm looking, let's say I want to set up a coffee shop, and I go to ORT, and in the area around the ORT offices, I put this little van and I sell coffee. I need to know the price I'm going to sell the coffee at, what's my costs of the coffee, the actual cost of the coffee and the cup and the sugars and that type of thing. That's my direct costs. That's my cost of sales. I get my gross profit. Then I need to work and understand, how much is ORT going to charge me a month rental? How much have I got to pay for salaries? These are things that I will pay for. Even if I don't sell any coffee, I still got to pay for those things. Then I land up and I can see where I'm at. I need to be able to do a calculation to work out how many coffees do I need to sell to make no profit. That's my break-even point. It's a way of starting and looking at a feasibility of something. So if I go through and I do this calculation and I work out that I need to sell 1,000 cups of coffee a month just to break even. If I sell 1,000 cups of coffee, I'm going to make no money. I start making money on that 1,001st cup, just after I've sold 1,000. That means if I do this calculation beforehand, if I understand everything beforehand, and let's say the number is 1,000 cups of coffee, then I look at the parking lot and I'll work out how many people come to ORT every day and how many of them would, I think, would actually buy the coffee. And if we do this calculation, I might find out that my potential market is about 200 people. So you can obviously see the situation. If I need 1,000 to break even, and my investigation tells me that only 200 would most probably, I'd sell up 200 in a month, I'm not even going to start the business. I don't want to start it and then fail. Then I can have a look at it and say, now, why is that the situation if I still want to be in the coffee game? And you might look and say, well, the cost of coffee is too much, or I'm paying too much in salaries, or whatever it is. Or I might say, is me putting the coffee shop in the ORT parking lot a good place? What is the flow through of people coming through and ordering coffees? Could I put that somewhere else? Could I maybe put that somewhere where there's a huge flow of people who want coffee? And a good example of that is just up the road from where I am. There's a guy who sells coffee. It's called Bird. He's near the Ethel Gray Park, and he sells coffee there. And he's got a little stand. I don't think the rent costs him too much. But the people going to the park, and the people going to the restaurants, and the people coming from the gyms around there, he's found a nice place that he's going to have lots of sales of coffee. And you need to look at every business like that. Okay, so your first thing is understand your break even, first of all. Second of all, you need to definitely understand those margins. And those margins are what I've just spoken about. Okay, what is my gross profit margin? And that's linked to markups. How much do I need to mark up my product to get there? And understand those fixed and variable costs. Just a quick thing on that. A variable cost is a cost that will vary, that will change with the amount of sales that you make. A fixed cost is something that is fixed. In other words, if I sell nothing, I still got to pay it. A nice example of that would be like rent. And then you can change it as well, that you can take a fixed cost and maybe change it into a variable cost. So instead of paying a fixed amount of rent, you could have what they call a turnover clause. So a business would say, I will pay you rent and it'll be 2% of my sales. That way it might protect you from, if you're not sure initially of what your sales will be. And then you need to go and investigate your business and say, what parts of my business consume the most? And then focus on how do I control the bits that focus that your biggest expense. If sugars and sweeteners and all that costs 2% of my total costs, I don't want to spend a huge amount of time trying to get that 2% down from whatever it is by 5%, because the impact's going to be nothing. I want to look at what is the biggest driver in my business and impact that bigger driver. And you can do ratios of anything divided by anything. I can take anything and do a ratio. And all a ratio is taking one number divided by another. And when I do that ratio, it must give me some insight. So whenever you do the ratio, ask yourself the question, and I've mentioned it earlier, is what's the what, the so what, and the now what? When I do the ratio, what am I looking at? What is that I'm looking at actually telling me? And what can I do about it once I've got the answer? You know, if you get an answer for something and you can't use it, then it's pointless even getting the answer. Okay. And some of the ratios you can look at, some of the simple ratios is your gross profit margin. Sales minus cost of sales is your gross profit as a percentage of sales. Some of it would be your net profit, which is that little drop that I spoke to earlier on the wine. And then you've got other ratios. And I've just given an illustration here, debtors days. In other words, if somebody says, I'm going to pay you later, on average, how long do you have to wait for your money? Because you've got to make a plan for the cash flow in the meantime. And the reason for doing these ratios is that you can make informed decisions. And if there's an issue, you can spot that earlier on. So if your gross profit margin isn't high enough, you need to make it high enough. And if you can't, then maybe don't go into that type of business. But it is better to know not to do it than to get burnt first. Okay. So if you can have a look and it's not, you don't want to spray and pray. You don't want to just say, I'm going to go into the ORT and they've said I can have that place and I'm going to try my best to sell coffees and I'm going to pray that I sell enough coffees when the chances of success are minimal. You'd rather do it where you go and you know there's a chance of greater success. And then people talk in finance about budgeting and finance and forecasting. A budget is your plan. You do a budget. How much am I going to spend on this? How much am I going to spend on that? How much am I going to spend? Both things are crucial, but your forecast is your reality check. Your forecast is saying, okay, so far I've done this. How much am I going to look at? And it's important to have a plan, but then to check where are you on that plan as we're going along. Now, when you've got a budget, and then you've got your actuals. How do we calculate what that is? And you do that by doing what we call a percentage increase calculation. And the percentage increase calculation is just, you take the difference between the two. So calculate, has it increased or decreased? So I've got the budget, and then I've got my actuals. What is the change? Then you take that divided by your budget, and you'll get this. And then you convert it to a percentage and you multiply by 100. Just understand what this calculation does. This is for a percentage increase, or if you're comparing it to the budget. Okay. Again, I'm going to go into something just now, but just I want to stop there for a second and just ask any comments or any questions?
No question.
Okay.
So, but can I please ask something?
Sure.
So, I'm just a small business, right?
Right.
And then I'm just trying to find a better way to ask this question. So I've got no idea what is even a break-even point. I mean, balance sheet, income statement. I'm fairly new on this, right? So, but what do you think I should do? Because one thing that I've noticed is that most of the people, they've got no idea what is an income statement, what it looks like. And then, I mean, we don't want to talk about the balance sheet. So, but what would you advise them?
So I would advise to maybe go on one of the courses that ORT offers you with a bootcamp that will take you through a little bit of that, but also educate yourself. Go onto AI or ChatGPT or find some information. It's very hard to be able to bake a cake if I don't know what I need to bake a cake. So when you're going into business, are you going into business just to occupy your time, or are you going into business to make some money? Then if you're going into business to make some money, you got to know what's the best way that I can make some money, and how do I know if I'm going to make it or not? And a lot of people intuitively have a sense about that and then get confused by a whole lot of these different terms. But it's important to know. So somebody who goes and sells these vet cook on the side of the road, if you had to go and ask them about an income statement and balance sheet, they'd have no idea, most probably. But if you ask them, are you making money? They would know. They know that if they cost them 2 rand to buy the vet cook, they can't sell it for 1.50 rand. They know they've got to sell it for 4 rand, because they know from the 4 rand, the 1 rand's going to go towards transport, you know, and they're going to keep the other rand. It's so I think a lot of people they have a sense of how to do it, but get confused by some of these other things. So if you can find a short course to just to give you the confidence to know that you're doing the right thing, that might be useful. And I know ORT offers a lot of these courses for small businesses. Okay.
Thank you. I am answered, and I think that they should at least advertise a little bit more of all these short courses that would help small business to know exactly what is it that they're getting themselves in. You know,
Absolutely.
because I'm actually just realizing that most of them, they've got no idea.
Yeah, and I think if you contact Tracy, she'll give you all the detail, or Karen will give you all the details around that.
Yes.
Great. Thank you. Thanks for that question. So I want to just give you a little bit of a story, because this illustrates in business kind of the background to the business. So it's just a story of somebody who sells watermelon. So if somebody buys watermelon for €1 and sells it for €1.50, why would somebody pay them more for the watermelon than it's costing them? And some people might say, well, they'll pay more because you're bringing the watermelon to them. So you would say, okay, it's got a benefit because you're bringing it to their location. You might buy it from them because you know that this person is very good at choosing quality watermelons. They whenever you buy with the watermelon from them, you know it's good quality. You might buy it from them because they will slice the watermelon for you, and you don't have to buy a whole watermelon if all you need is a quarter of a watermelon. You might buy it because they know where the source of the watermelon comes from. You don't even know where to go and look. Now, all of these things, and if I gave you some time and I asked you the question, you'd come up with a list of like 10 or 20 of these. All of these things, the location, the quality, the slicing of it, all of these things are what we call added value. You're willing to pay more because the person giving you the watermelon is adding value to the product. And you must look at what you're doing and say, whatever you're doing, how do you add value to the person who's buying it from you? If that person could go directly to the source, what are you doing that would stop them from doing that? So we know we got Temu. I must tell you a story. I took my daughter to a little Chinese market not far from us. It was the first time she'd gone into the Chinese market, and she walked in. It was a big warehouse, and she looked around and she said, "Dad, wow, this is like a real life Temu." And the question is, why, if I could get everything off Temu, why would I still go and buy somewhere else? What is the added benefit? The added benefit might be, I don't want to hassle with having to get these emails and pay on a credit card and not sure if it's going to come. Or the added value might be, I don't want to buy clothing and then it comes and it's for a different group of people where a large means something else, and then I've wasted my money. Or to get it back would be an issue. Or I need it today and it's going to take 2 weeks. All those things are added value. And that's why I might go somewhere to try it. Or I want to try it on. Part of it is not just getting the product, it's trying it on. So whatever you're doing, have a look and see if you can add value. Now, adding value might be adding value, selling the same item. In other words, like this example, I buy a watermelon, I sell a watermelon. I might sell it slightly different with just the slice, but it's still just the watermelon. Or I could take this and change the product completely. And changing the product completely means making watermelon juice. And then when I serve it, I want to serve it in a way that it looks amazing, because then people pay me more. That little umbrella on that watermelon juice is not adding to the taste of the juice itself, but it's making the person tasting the juice feel better about themselves. I can serve you the same watermelon juice in a dirty, broken cup, or in a beautiful glass that's presented well, and it'll feel better if it's in a beautiful cup rather than in something that looks dirty and somebody might have had to drink from it. Okay, so always what you're doing is ask yourself, how am I adding value to the person who is buying the product? And part of that added value is always ask yourself, what is the problem I am solving? People pay to have problems solved, generally. How is what I'm selling solving a problem to the customer? If you can work that out, you can work out how you could sell it to them. Okay. And when you analyze a business and when you do these different ratios, it's no good looking at one thing. You know, some people come to me and they say, David, like, if you had to invest in a company, what's the one thing you should look at? And there is no one thing. There's a lot of things. And that's why when you analyze things or you do ratios, you're looking at that, but it's like a jigsaw puzzle. I can't just look at one piece in a puzzle and say that's a great puzzle. I have to take all these other pieces and put it together. And even when I put it together, I don't know what the bigger picture is. I need to understand, where does this fit in with the bigger picture, and know where in that bigger picture this fits. And then I can understand it. Okay. So everything needs to be understood within the context of what it is. It's like if I ask you what this is, you might not know. If I tell you it's one of these things, I'm adding value, but I'm not answering your question. Can you see that? Yes, it's one of these. But when you put it into context, then I can understand, oh, that's South Africa, because it fits within all of these things. So the important thing around this is to understand how what I'm doing, does it fit into the bigger context? What is happening in the bigger environment? Okay. It is very hard for me to sell water, bottled water, if there's water everywhere and it's for free. I can't charge too much for it. But if I'm in the desert and there's no water, that becomes the most valuable product that you can have. It's not your product only that creates the value, it's the context that your product is in. Have a look at the marketplace. What do people want? What do people need? And if you can sell that people need and you're solving a problem, that's the key thing that we're looking at. I want to go through one last thing just to illustrate how some of these simple calculations can help. And I'm going to stop this presentation and I'm just going to go to a spreadsheet, because what this gives you is, this is just an income statement of a company and it's looking at this year and last year. And if I say this year, and I'm just going to put 2025 here, and last year, let's say, was 2024, and it shouldn't actually be like that. Let's do it 2025, makes more sense, and 2024. So if I asked you, which year did we make more money? What year would you say we made more money? And you can just call it out. Anyone, what's your guess? You got a chance of getting it right with 2. Which year did we make more money? Odette says 2025. Absolutely. Odette, why do you say we made more money in 2025? You're correct, but why did you say that? And you must probably say that because there, whoops, let's go over here. Because over here, right at the bottom, yeah, your net income is higher. You made 192,000 compared to 189,000. So clearly, you made more money in 2025 than you did in 2024. But if we do one of those calculations that I mentioned, if we do the calculation where we take this as a percentage of your sales, and if we did that, you would find out that although we made 192,000, it's 10%. We made 10% of our sales, where the previous year we made less money, but the percentage is higher. What that is telling us is you made more money this year, but you were less efficient. You made more money, but you should have made even more money. And the question is, where did we lose this money? How come we made less? And if we do that horizontal analysis, what I said to you is taking the difference between the two, what you get here, it shows you that your sales grew by 10%, but my profit only grew by 1.5%. What that means is it's like going and filling a bucket with a whole lot of water. Let's say 10 liters of water, and I walk home, and when I get home, I've only got 1.5. It's leaking somewhere. It's spilling somewhere. Where's it spilling? I look at anything that's got a higher percentage than the 10%, and that would obviously be cost of sales, but also utilities, because look at the utilities, that's 88%. And so this is telling me where the problem, I'm starting to analyze this to see where is the issue, where's the problem within this. Now, a lot of people say our biggest problem is utilities because it's 88%. But percentages are very useful, but can be misleading. And it's misleading if it comes off what we call a low base. It comes off a lower number. What I mean by that, if I go from 1 to 2, the change is 1, that's 100% jump. But going from 100 to 101, or let's say going from 100 to 102, that's a change of 2, which is double the 1, but it's only a 2% change because it depends on the basis. So very important is to see what the actual movement was, and your cost of sales was 152,000. So your biggest issue, the first thing I'd go and look at is what is the thing that can have the biggest impact, and the thing that can have the biggest impact is your cost of sales. Okay, and I'd focus on there. And then I'd go and have a look at utilities. Why did that go up? Was it an increase in Eskom tariffs, for instance? But the key thing is here is just to have a look and say, what was the cause, and then what can I do about it? Go back to the what, the so what, the now what. What are we looking at? What is the impact, and can we do something about that impact? Okay, that's the purpose of doing analysis. If you just analyze things and you don't make a decision with it, then it's what we call analysis paralysis, because you're just analyzing. You need to look at things so that you can make decisions based on that. Okay, I'm going to stop it now and ask some questions, but before I get to those questions, I do want to go to one other thing, if I can find it here. Okay. And I do want to just show you one more thing quickly. And it's just at the end, Tracy will put out a survey. And if you wouldn't mind just answering the survey in terms of, was this useful for you? Can we do something different? Can we do it better? Etc. etc. So there'll be some questions just at the end. There'll be a link for the survey. But
thank you, David. I have put it into the chat box already.
okay, fantastic. So if you look in the chat box, you'll see Tracy says, please take a moment to complete the ORT Jet feedback survey. Guys, that's very important for us because it allows us to see if we're doing the right thing and creating more and more stuff for you. So Philip says in the chat, hi David, can you please provide us with a basic formula for calculating the basic change on percentages? Yeah. So the formula would be, and in fact, let me go back. It's exactly that slide that I showed a little bit earlier. And I'm going to get to that and share that with you. Let's go back over here. And yeah, there we go. And by the way, these slides will be available. Tracy will send it to you. But this is, Philip, this is the formula that one would look at. It is calculate the increase or decrease. So if you're trying to see what's a percentage increase, what is the change from the one period to the other? Then say, where did we start from? That would be your second step. Your third step would be take the difference divided by where you start from. You get an answer. That answer would be in a decimal point. You need to multiply it by 100 to get it to be a percentage. And when you get that, that's how you would get your percentage. So you can either, if you know how to, you can just copy or take a picture of this formula now on the screen, or you can wait until Tracy sends you, and she'll send you this in the presentation. Either Tracy or Corin will send it to you. Any other comments or questions, guys?
David, it's me again.
Yes.
I came in a bit late. I'm not really sure what is it that you've covered when it comes to calculating the cost. So I'm just going to give you an example. I'm a small business, right? And then I want to start a business, but I don't know how to calculate the cost of the product that I'm about to sell. Okay. Let's say I'm selling clothes.
Right.
And then how do I then calculate the cost of the sales of this particular clothes that I'm about to sell?
Okay, so first of all, are you looking to calculate the cost of the sale, or are you looking to calculate the selling price that you should sell it for?
The selling price. The selling price.
Okay. Great. So the first thing, yeah, the first, say it again.
So, but what is it that it entails? How do I list my cost? Like everything that you can advise.
Yeah. So first of all, you need to be very clear and for yourself, what are you trying to do? So even that terminology of understanding, are you trying to calculate the cost or the selling prices? You've got to be very clear of what you're looking to do. Now, you have to, and it's ironic you said you want to know the cost, because that is the first thing you need to know. For me to know what my selling price is, I need to know what my cost is. Your most basic cost is what it's costing you on average to get the product. That you would need definitely to cover that. You would also need to look at what other costs are involved in getting it. So if I'm buying the dress from somebody, it costs me 100 Rand, but I've got to travel there and get it and come back. And if I'm only buying one dress at a time, that petrol might be 50 bucks. So now my cost of that one dress is 150 bucks. Where I could be more efficient is if when I go and I travel there, I don't buy just the one dress. I buy 50 dresses, because then it adds only 1 Rand to that cost. But then I've got other costs, because now I need cost of, I need the money available, first of all, to do that. I need a storage space for it. I need security for it. I've got the risk of it being stolen. So there are other costs that come into. But if you go back to your main question, then what you need to do is look at all the input costs of getting the product available to sell. And then you need to look and say, what margin should I get? What do I want the GP to be? And then you add on the cost to get to the GP. And then you get to a price. And if your price of this is around, let's say, 600 Rand, you need to go and see what are the other people selling that same kind of dress for? And is it in the right kind of price range? Because if others can buy it and you're not adding much of that value, then why would people pay you more for it than they can get from somewhere else? So you need to look at all your input costs and all your running costs so that you make a profit from it. But at the same time, it mustn't be more expensive than somewhere else. If I open up a coffee shop, and even if my coffee is much, much better than anyone else, if I charge 100 Rand per cappuccino, I might sell one or two, but I'm not going to get much repeated business because they can get the coffee somewhere else and it's not giving them something more than what they want. But this is where, if you're looking at this, this is definitely where you need to go on a small business course to be able to work that out. So somebody said, or Christine said, would it be possible to give us an Excel template to use? Yes and no. So I could give you a template of some of the stuff that you'd need to put in, but in each situation, it would be slightly different. So you would have to look at all those costs and work it out. But and if you go into whatever your business is, I promise you, if you go and you Google it or you look at AI will give you most of that information that you need. Thank you. Thank you, everyone.